Welcome back once again, options traders, and happy Monday. I hope everybody had a great weekend and ready for some more options training. Well, I got a special request from one of our traders by an email asking to go over positive and negative gamma. And he said that he found this very confusing, and it is. And in fact, I have found that even for traders who think that they understand it, don't really understand what makes it positive or negative, where those are coming from, much less how to use it. But for this video, let's just keep it simple and talk about positive and negative gamma. What are these terms all about? As always, before we do, please be sure to click like and subscribe. It's greatly appreciated and helps to promote the channel. So let's start off with deltas. You really can't understand gamma until you understand delta. So whenever we talk about delta in options trading, what we're talking about is the slope, or think of it as the pitch. You can think of it as the angle, even though it's not the same thing. The angle is not the same as the delta, but they are related. But it's the kind of the angle that this line lies on. So let's say that this is shares of stock purchased for 100. So we can see that if we own one share of stock and the stock rises from 100 to 101, that's a $1 rise. And if that happens, you're going to make $1. No surprise there. So we can see that at 101, if we trace a line up to our risk graph and over, it lines up exactly at 1. Well, what if we had gone up $2? Well, a $2 change would equate to a $2 increase in profits. But it's still a 1-to-1 ratio. What would happen if we go in the other direction? What if we fall a dollar from 100 to 99? That's a $1 fall, and that will lead to a $1 drop in our profits or losses. This would create a $1 loss. So we can see at 99, we trace a line right down here to the black, and that lines up at -1. But again, it is a 1-to-1 ratio. So long shares of stock are always positive 1. And all that means is that for every dollar that the stock rises, you make $1, and for every dollar that it falls, you lose $1. Now, of course, we can change the number of deltas. This is one share of stock, but let's start with 0. If you have 0 shares of stock, you have 0 slope or 0 deltas. So think of it like a snow ski mountain here, of course, at the very bottom, but we are dead flat, not going to go anywhere because there's no slope to it. And that's what's going to happen if you have no shares of stock. It doesn't matter where the stock goes, you're not gaining or losing. But let's say you buy 10 shares. Well, now we get a little bit of a pitch to it. Still not a lot. The orange line is fairly flat, but it's certainly not 0. Then we could have 20 shares, 30, 40, 50, 60. We just keep on moving up here. Here's 100 shares. So go back to our snow skier. You can see that now we're going to get some speed because there's more slope. We have more deltas. In this case, for every dollar that we move to the right, we're going to pick up $100 because we have 100 shares, or in options trading, we would call it 100 deltas. So you can see that with shares of stock, it's a straight line. Yes, the more deltas you have, the more you make when the stock goes up. That's the fun part, but it also means the more you lose when it goes down. So the thing to take at this point is to remember that stock is always delta 1. It just means that it always gains and loses dollar for dollar. And if that's true, your gamma is 0. So if you recall from some of our earlier videos, gamma tells you the rate of change of your deltas. And that's why it's sometimes called the delta of the delta. Your deltas tell you the rate of change of your profits, as we just saw. So we just saw that shares of stock plot as a straight line, and so it always calculates to be delta 1. So no matter where we measure, see on the previous couple of slides we measured from 100 to 101 and from 100 to 102, and we looked at it from 100 down to 99. We looked at 3 different cases. Well, it doesn't matter which numbers you pick. No matter what you pick, it is always going to come out to be delta 1. So if we measured it in a very small area in here, we'd find that that slope is delta 1. If we're in this area, we'd get delta 1, delta 1, delta 1, delta 1. We always get delta 1. So now ask yourself, how are those deltas changing? What's the difference in the delta here at delta 1 and right here at delta 1? Well, there's no difference. And if there's no change or no difference in your deltas, then your gamma is 0. A gamma of 0 just says that your deltas aren't changing. So if we measured from here with delta 1 or here at delta 1, what's the difference in those two measurements? 0. Your gamma is 0. Same here. Gamma is 0. Gamma is 0. It doesn't matter where you measure on a straight line, we're going to get slope or delta of 1 and gamma of 0. So another way to understand gamma is that it's the curvature. That's a good way to visualize it. So if you're looking at a straight line, like this one here in black, there's no curvature, so there's no gamma. But mathematically, that's why. We're just saying that there's no change in those deltas. Okay, so if you remember that gamma equals curvature, now you'll have a better understanding when we're talking about gamma for options. So let's look at a risk profile for an option. Let's say for a call option, this might be with 30 days to expiration. Now this is the current curve, again with 30 days to expiration, but you can see that it's curved. It's not a straight line. That's the key insight. So we know that it has gamma. But what kind of gamma? Well, now let's think about the slopes. Down here, we're fairly flat. Remember when we saw our snow skier on the very flat line? Well, this entire curve isn't flat, but it's very flat right here. So if we were to measure in this very small area, we would come up with a delta of 0. If we move away from it a little bit, now we might come up with a delta of 25. If we come up here to at the money, let's say with a 100 strike, we're going to get a delta roughly of 50. As the stock pushes further, we start going in the money. You can see up here we're starting to get some pretty good pitch to it. So we might have delta 75. Not everywhere, but just right here. And then finally, if we go super deep in the money, that's when we're going to get delta 1, or because options control 100 shares, it would be delta 100. So again, what is that telling us? Well, if you think back to that chart, we saw all of those deltas with our snow skiers. Let's pull out the delta that was 50. And if we were to plot 50 deltas or 50 shares of stock on this graph, it might look like this. Not 100 shares, it's 50 shares. Well, notice that if we move it to different parts of this line, it doesn't match up. Look where the black and the blue lines cross. They're very different. The black is much steeper. If that were your snow ski mountain, you'd be much faster in this range than on the blue. So we can tell on this black line that's not delta 50. Well, what about down here? Well, again, we can look at where the black and the blue lines cross. Very different. We're still relatively flat here on the black line. We have some pretty good deltas here on the blue. They do not match up. And that's going to be true anywhere on this black line except for one area. And that's right there. Now notice it's not everywhere, but just in this little tiny area. So there we would say, all right, the black and the blue lines kind of almost look exactly the same. So we would say the delta is 50, again, not everywhere on the black line, just right here. So the thing that you want to understand visually is that if you look at this black line, if it looks like a smile kind of curving up this way, you have positive gamma. And what that is telling you is this. It's very simple. Stock up, and stock down, delta down. Notice that the direction of the stock is exactly the same as the direction of the deltas. Stock up, delta's up, stock down, delta down. That is positive gamma. So let's check it. As the stock moves up, going in this direction, we go from 0, and then up here we get into 25. Stock up, delta's up. We went from 0 to 25. As the stock continues higher, we go from 25 to 50. Deltas are increasing. Stock up some more, we increase our deltas. Stock up some more, we increase our deltas. Now, eventually beyond here, we're not going to have more than 100 deltas for one contract, but that also means we will have gamma 0, at least in those areas. So the thing with positive gamma, the simplest way to understand is stock up, stock down, delta down. So look at it in reverse. What if the stock falls? Now we go from 100 to 75. The deltas have been reduced. Stock falls some more, we go from 75 to 50, 50 to 25, and 25 to 0. As the stock falls, the deltas are falling as well. And that is positive gamma. So what's it going to look like for a long put? Now this is where traders get confused and they'll say, oh, well, a put has negative deltas, so therefore it's got negative gamma. Nope, it has positive gamma. Notice it looks like a smile. Remember, that's always going to be your telltale sign. If it's curving upwards, or at least it's probably more of a smirk, but a little bit more in line with a smile, certainly as opposed to a frown. And what that's telling you is stock up, stock down, delta down. So if we were to plot the deltas, we might be negative 100 up here. We're behaving like short 100 shares of stock. And then maybe minus 75, minus 50, minus 25, and then 0. So take a look. As the stock goes up, what's happening to our deltas? We go from minus 100 to minus 75. Now here's where traders get tripped up. They'll say, well, wait a minute, that's falling. You're going from 100 to 75, and then 75 to 50, and 25 and 0. We're reducing our deltas. No, you're not, because we're dealing with negative numbers. So think of it like money. If you have a checking account that's overdrawn, you've got negative $100, and you add $25 to it, what do you have? You have minus 75. Your balance has increased. It didn't decrease. You had to add money to go from minus 100 to minus 75. Same with negative deltas. To go from minus 75 to minus 50, if it were money, you'd have to deposit another 25 bucks. And then deposit another 25, and eventually you would get to 0. And then consider what's going to happen if you kept adding. You'd go plus 25, plus 50, plus 75. That's increasing your deltas. So again, the thing that traders, where they get tripped up, is they just look at the raw number, what's called the absolute number, and they say you're going from 100 to 75 and 50, that your deltas are decreasing. They are not. They are increasing. And so if you remember that, now it makes sense. Stock up, stock down, delta down. So let's try it in reverse. If we have 0 deltas down here and the stock falls, we subtracted 25 deltas, and that's how we went from 0 to minus 25. As the stock fell some more, we went from minus 25 to minus 50. We subtracted another 25 deltas. The deltas are being reduced. As we fall some more, we go from minus 50 to minus 75, and then finally minus 100. So yes, I know it does look backwards, but mathematically it's correct. So just remember, anytime you have a smile, it is stock up, stock down, delta down. Now when we have negative gamma, now things are going to get reversed. So let's say that this is a short put. So we now have negative gamma. So anytime that you buy an option, you've got positive gamma. Anytime that you sell an option, you've got negative gamma. So now our negative gamma looks like a frown. And yes, everything's going to be reversed. Stock up, delta down, stock down, delta up. So up here, we've got a very flat slope. Our little snow ski area just in this region is very flat, so we have 0 deltas. Then maybe we get to 25, then maybe around 50 here at the money, 75 down here, and then finally 100. So take a look at our definition. As the stock goes up, our deltas go down. Is that true? We're going from 100, 75, 50, 25, and 0. Stock is going up this way, our deltas are being reduced. What if the stock goes down? Well, now we're heading in this direction. We go from 0, 25, 50, 75, 100. The deltas are increasing. Stock down, delta up. So that's what makes it negative gamma, is that your deltas are moving in the opposite direction of the stock. So what do you suppose we have for a short call? Same idea. Now it looks like a frown. We have a short option anytime you have a short option, you have negative gamma. So a short call, we've got negative gamma. We can see we've got gamma, it's bending, but we can also see it's kind of bending downwards this way like a frown. So we know it's negative gamma. And what does negative gamma tell you? Stock up, delta down, stock down, delta up. So let's see if it's true. If we start down here, we've got a fairly flat section, delta 0. Now up here we might be delta minus 25. Over here we might be delta minus 50. In this region we might be delta minus 75, and up here minus 100. See, we're looking like short shares of stock. Our deltas are leaning this way to the left. So let's check our definition. Stock up, delta down. As the stock moves this way, we subtracted 25. Isn't that reducing the deltas? We subtracted 25 again, subtracted 25 again, subtracted 25 down here. As the stock is going up, we are reducing our deltas. Now, yes, I know that it looks odd. You're going to say, but wait a minute, the numbers are getting bigger. Well, again, that's the absolute value. And yes, it is true that your sensitivity is getting bigger. Up here, you have no sensitivity to changes in the stock's price. Up here, you've got lots of sensitivity. But if you want to understand the definition, it's that your deltas are being subtracted as the stock price goes up. And then as the stock price goes down, we just reverse the process. We go from minus 100 to minus 75. This is what we saw with a long put. We are adding 25 deltas. So stock down, delta up. Stock falls some more. We go from minus 75 up here to minus 50. We have added deltas. Then the stock falls to here. Now we're at minus 25. We've added deltas. Stock falls some more. We get to 0. So we have to add deltas as the stock price falls. That's what's making it negative gamma. And if you remember those definitions, it will go a long way into helping you understand some of the more advanced strategies. So why is this important? Well, here's a simple example. Let's look at a covered call. We own 100 shares of stock, and we've sold a call. So here maybe we sold the 105 call. There's our bend. What kind of gamma does long stock have? 0. What kind of gamma does a short call have? Negative. So 0 plus a negative is going to give us a negative gamma. And we can see it here. Got this kind of a frown shape to it. So one thing you can do is to recognize that your deltas are going to be decreasing as the stock goes up. See, if the stock falls way down here, your call's out of the money, basically worthless. You're holding on to shares of stock, so your deltas are very high, probably delta 100 down here. If the stock rises, maybe delta 75, delta 50, delta 25, and finally if that call goes deep in the money, you're at delta 0. That's because your stock has positive 100 deltas and your short call has minus 100. So one thing you can do strategically is to say, well, what's the reason for putting this strategy on? And a lot of times traders say, oh, I'm super bullish. Let me do a covered call because I can get a credit. But what kind of gamma does that have? It's negative. What are you doing as the stock rises? Do you want to be letting shares go? Do you want to be selling off shares into the rising market? Because that's what you're doing. And conversely, if the stock falls, do you want to be accumulating deltas and be getting into a longer delta position as the stock price falls? Well, it depends on what you're trying to do. That's actually a strategy called fading the market, where people are selling into a rising market or buying into a falling market. But if your outlook is, I want to be bullish and I want to make money as the stock price rises, this is clearly not your strategy. And how do we know? Because we can tell instantly it has negative gamma. So I hope that helps to at least get through the definitions. And once you get through the definitions, it will then make your decisions a lot easier about what kind of delta you're looking for, that's direction, but specifically, what kind of gamma? Are you trying to accumulate deltas as the stock rises? Or are you trying to get shorter? Or are you trying to get longer as the stock price falls? Or shorter as the stock price falls? That's where your positive and negative gammas come in. So for right now, just work on positive and negative gammas, and we can talk about strategic applications in future videos. And for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a Candlesticks and Technical Analysis course. It's all at optionsatoz.com. Also, please join us on Options A to Z's Facebook trading group, and you can find a link in the description below.